On April 28th, Americans got some real bad news. Real gross domestic product, or real GDP, turned negative in Q1. For those of you that haven't touched your Finance 101 textbooks since college like me, gross domestic product is essentially the total value of goods produced and services provided in a country during 1 year. Think of GDP like the total salary that you bring in. The higher, the better. Real gross domestic product is simply GDP adjusted for inflation. Naturally, when GDP is positive or growing, that means the country is making more than a year ago. And when GDP is negative, it means the country is producing less. The textbook definition of an economic recession is when a country prints 2 consecutive quarters of negative GDP. So the United States is one more negative quarter from officially being in a recession. In other words, the United States might be in a recession right now. But what does that mean for stock prices? GDP has been negative before, so what has happened to stocks leading up to and after GDP turns negative? On today's video, we'll find out. Let's flash back to the year 2000. The United States hadn't experienced negative real GDP in over a decade, and the stock market was in the midst of one of the longest and steepest bull runs the stock market had ever seen. In Q1 of 2001, the stock market actually looked eerily similar to today's market. In fact, it almost looked identical. After years of the market only going up, the first cracks in the market started showing up in late 2000. By Q1 2001, the first negative GDP print appeared for the first time in over a decade. At the time, the S&P 500 index was trading around 1,300 in January. 2 years later, the S&P 500 was under 900. That was a 30% decline in 2 years. Following that massive decline, stocks naturally went on another bull run, but it wasn't until 4 years later, in 2007, when the S&P 500 was back over 1,500, the highs the market saw before the 30% crash between 2001 and 2003. Ironically, just like in 2001, GDP turned negative in Q1 of 2008, just 1 quarter after the stock market had made all-time highs again. And just like in 2001, the stock market crashed, this time in spectacular fashion over a 14-month span, dropping from over 1,400 in January of 2008 to infamously bottoming in March of 2009 at 666. That was a 54% decline. Since 2009, real GDP has turned negative a few times with mixed results. In 2011, real GDP turned negative in Q1, which signaled another market top, as stocks fell about 20% over the following 6 months. GDP was negative again in Q1 of 2014. However, stocks increased, leading all the way into the 2016 presidential election. The most dramatic GDP decline was, of course, in 2020 when COVID-19 first reached the shores here in the United States. This time, the decline in GDP was well telegraphed and understood. However, stocks still declined over 30% during that first quarter alone. That leads us back to today. Just like in 2001 and 2008, the stock market has a massive bull run in its rear view. The stock charts, the topping pattern, the Q1 negative real GDP number all looks nearly identical if you compare the three. Looking ahead, if the stock market acts anything like 2001 and 2008, stocks will decline even more. A 30% decline from the highs we made back in January of 2022 will take the stock market below 3,300. A 50% decline would take us below 2,400. Could stocks reverse and go higher in the coming months? Sure, it's possible, but history shows that when the United States economy prints a real negative GDP number, it's only the start of stock market declines.